Welcome back to the deep dive. Today, we are all in on our talk tickers persona. This is the session where we cut through the glossy press releases and get right into the nuts and bolts of the market for the serious investor.
Exactly.
It is Thursday, February 5th, 2026. We are deep in earnings season, and we're zeroing in on one name, ConocoPhillips, ticker symbol COP.
And it's a tense day to be watching this one. If you've got the screens up, you can feel the mood. The market is absolutely in show me mode.
Show me is a nice way of putting it. The stock is down, about 2.5% as we speak?
Yeah, trading around 105, down from near 108.
It feels like the market's trying to process what I've been calling a two clocks situation. You have the messy quarter that just happened right now versus this really polished, optimized future that management is selling.
That's the perfect way to frame it. The shorthand on the clock is stuck on the immediate results, which were dragged down by commodity prices. But the longhand is pointing years down the road to this massive cash flow story.
And the market, as usual, is voting with the shorthand.
It always does. So to figure out if that's the right vote, we have to start with the messy part first, the actual print.
Let's do it. Unpack the immediate pain for us. ConocoPhillips reported Q4 2025 results, and to be blunt, they missed.
They did. So let's hit the headline numbers that got the algorithm selling this morning. Adjusted earnings per share, it came in at $1.02.
$1.02. And the street was looking for what, 111?
Exactly, 111.
Yeah.
That's a 9-cent miss. An 8% miss against expectations, which is, not insignificant.
And the top line, revenue.
Also a miss. Came in at $13.39 billion. Against estimates of about $14.14 billion.
Okay, so when you see misses on both the top and bottom line for an upstream company, there's usually one main culprit.
It's almost always commodity prices. The volume was there, but the price they got for it just wasn't.
So what was the price?
The average realized price for the quarter was $42.46 per barrel of oil equivalent. That is a 19% drop year over year.
And I think it's worth just pausing on realized price for a second. This isn't just the WTI crude price you see on TV, right?
No, not at all. And the difference really matters. The realized price is what they actually get after you factor in their entire mix of products. So it's not just oil, it's natural gas liquids by Yemen.
And it includes all their hedging, transportation costs, everything.
Everything. So their specific basket of goods sold for almost 20% less than it did a year ago. When that happens, your margins just get squeezed instantly.
Right. And that's what we saw in the GAAP EPS. It fell to $1.17 from $1.90 in the same quarter last year. But, and this is the key point, this wasn't an operational breakdown.
No, the engine itself is running fine. That's what makes it so frustrating for the bulls. Production actually hit 2.32 million barrels of oil equivalent per day.
Which is pretty solid growth.
It's roughly 6.3% year-over-year growth. And they still generated $4.3 billion in cash from operations, even with those lower prices.
So the market is just trading the headline miss and getting spooked by that $42 price.
It's short-sighted, but that's the tape today. The market is saying, prove to us the future is worth waiting for. Which, of course, is exactly what management spent the entire call trying to do.
Right. They desperately wanted to pivot to the strategy, the guidance for 2026, and the whole efficiency story.
And if you had to boil that whole story down to one phrase, it's cost down. I mean, they are guiding for a full $1 billion combined reduction in capital and operating costs this year.
$1 billion. In an inflationary world, how are they planning to pull that off?
It's a two-pronged attack. They're guiding CapEx, their investment budget, down to about $12 billion. That's a $600 million cut from 2025.
Okay, and the other $400 million.
That's coming from OPEX, their daily running costs. They're guiding that down to about $10.2 billion.
A huge piece of this puzzle has to be the Marathon Oil integration. I think everyone was watching to see how that would play out.
And according to the call, it's playing out surprisingly well. They said synergy capture has actually doubled versus their initial plan. They've realized about $1 billion in one-time benefits.
Yeah, but the stat that really jumped out at me.
I think I know what you're going to say.
Yeah.
They eliminated the Marathon Capital Program.
They completely eliminated it while keeping the production. How is that even possible? Don't you need to spend money to keep wells flowing?
You do, but this is where the scale comes in. They absorbed Marathon's assets, looked at their drilling schedule, and basically said, we don't need this. We can maintain this production by just high-grading the best spots and using our own more efficient infrastructure.
So they're running the Marathon assets for free from a new capital perspective.
That's the idea. It is ruthless efficiency. It's the difference between just buying a company and truly integrating it.
Okay, so they're cutting costs. But you buy an E&P for the cash flow, and this is where they dropped the holy grail target.
The free cash flow inflection. This is the entire bull case in a nutshell. They're targeting $7 billion in incremental free cash flow by 2029.
Let's stress that word incremental, not 7 billion total, 7 billion extra.
Exactly. 7 billion more than today's baseline. And they have a path to get there, like a staircase. They're planning about $1 billion of incremental free cash flow each year in 26, 27, and 28.
That's from the cost cuts and efficiencies we just talked about.
Right. But the kicker, the huge jump, is a massive $4 billion step up in 2029.
And that has a name.
It's Willow. Almost all of that is the Willow project coming online.
We have to talk about Willow. It's controversial, it's huge, and it's the linchpin of this entire long-term thesis. Where does it stand right now?
The update was really solid. They said it's nearing 50% completion. First oil is still scheduled for early 2029. But the little detail that caught my ear was about the weather.
What about it?
They got an early freeze. The ice roads froze ahead of schedule, which let them start the winter construction season early.
And for anyone who doesn't follow Arctic construction, explain why ice roads are so critical.
Well, you can't move heavy equipment across the tundra in the summer. You just sink. You need the ground to be frozen solid to build these temporary highways out of ice. If the freeze is late, your entire construction window shrinks.
So an early freeze means they're ahead of schedule on logistics.
Which is rare for a project this massive, especially in the Arctic. It's a good sign.
Okay, so Willow is the 2029 story. What about the bridge to get there? They also mentioned LNG.
Right. Their LNG projects are over 80% complete. Specifically, the NFS project should start up in the second half of this year, 2026. So that will start generating some cash flow soon, helping to bridge that gap.
And back in the lower 48, in the shale patch, they're not standing still either.
No. They reported drilling and completion efficiencies improved by over 15% last year. And the big driver is just drilling longer wells. They said 90% of their wells this year will have laterals longer than 2 miles.
So just to break that down, that means they drill down vertically, then turn the bit and drill sideways through the rock for 2 miles or more.
Exactly. And the longer you can drill sideways, the more oil-rich rock you contact for roughly the same setup cost up top.
Yeah.
It just crushes your cost per barrel.
Okay, so better drilling, cost cuts, big projects on the horizon. How does the shareholder get paid to wait for all this?
They returned $9 billion to shareholders in 2025. That was 45% of their cash from operations.
And they're sticking to that target.
They reiterated the plan to return about 45% of CFO this year, too. Plus, the base dividend is growing at a top quartile S&P 500 rate. It's 84 cents a share for the first quarter.
So you're basically collecting a nice yield while you wait for that 2029 growth story to hit.
That's the pitch. You're parking your money in a dividend payer that has this massive growth option attached to it.
I want to zoom out to the Q&A because there was some interesting strategic signals there. That M&A market is on fire right now.
It is. But when they were asked about it, CEO Ryan Lance was really clear. He said, and I'm quoting, "We've done our heavy lifting."
So they're sitting this round out.
It sounds like it. They feel they bought Marathon, they filled any strategic gaps, and now the focus is purely on organic execution. They are not chasing deals.
Which is probably a relief to some investors who worry about companies overpaying at the top of the cycle.
Right. Instead of M&A, they leaned really hard on their fortress balance sheet argument. And they dropped a number that just made my jaw drop.
What was it?
They are aiming for a corporate break-even oil price in the low $30 range by the end of the decade.
The low 30s. The WTI is over $70 right now.
I know. Think about that. If oil crashes to 35, a level that would bankrupt half the industry, Conoco is still breaking even. At 70, they're just printing cash.
They also had to address a few geopolitical hotspots. What was the update on Venezuela?
It's not about operations anymore. It's about getting paid. Their priority is just recovering money they're owed through litigation. They're supporting the U.S. government's position on CITGO because that's their best path to collecting on their awards.
And Libya.
A surprisingly good update, actually. They extended their concession and got better fiscal terms, which makes those barrels more profitable. It's a nice little bonus.
There was also a specific rig incident in Alaska that they had to address.
Yeah, rig D26. But the takeaway was that it's all handled. No injuries, most importantly, and no impact to any timelines. They just swapped in another rig and kept going.
A sign of operational depth.
Exactly.
Yeah.
The last thing they really flexed on was their inventory depth. Their organic reserve replacement was around 100% for the year.
And let's quickly define that. That means for every barrel they pumped out of the ground?
They found another barrel to replace it, just through their own drilling. It means they aren't slowly liquidating the company. They're sustainable.
Okay. So let's pull all this together before we get to our favorite part of the show.
The setup is a stock that's down today because of short-term commodity weakness versus a management team that's pointing to a massive cash flow story 3 years from now. It is a total test of investor patience.
Which brings us to our outrageous but plausible trade idea. And as always, please remember, this is not financial advice. This is for educational and entertainment purposes only. Do your own work.
Absolutely. So I'm calling this trade the Willow 2029 slingshot.
The slingshot. Okay, I like it. What's the thesis?
The thesis is simple. The market hates today's 9-cent earnings miss. It hates the commodity drag. But it is severely underpricing that $7 billion free cash flow inflection coming in 2029.
The market is being nearsighted.
Completely. So the trade is you fade this negative reaction, you use this weakness to accumulate either the stock itself whenever it gets near $100, or if you're more aggressive, you buy LEPS, long-dated call options.
So you're buying the dip on the boring news today to position for the really exciting news down the road?
You're buying what is effectively a bond, the dividend payments, that has a lottery ticket attached to it that cashes in 2029 when Willow drops $4 billion of cash on the balance sheet.
It's a volatility arbitrage play.
It is. You're betting that this boring cost-cutting phase from 26 to 28 is just coiling the spring for a massive re-rating of the stock when the cash flow hits.
I like it. But to make it a true hedge fund style trade, I'd add a short leg.
Oh, yeah. What's the other side of the pair?
I would short a pure play shale driller that's running out of tier 1 inventory, one of the companies that has maybe 4 or 5 years of prime drilling locations left.
Oh, that's a brutal pair trade.
You go long the company with 20 plus years of inventory and a massive growth project, and you short the one that's about to see its cost go up as it moves to lower quality rock.
It's compelling, but very high risk, obviously.
Yeah.
If oil tanks for 3 years, those LEPs are going to zero.
Always. Okay, so wrapping this up, final verdict on ConocoPhillips.
A messy quarter on the surface. The miss stings, and the stock is reflecting that today. But underneath, it's a disciplined machine building towards a really powerful 2029 story.
And what's the one thing listeners should watch for over the next year to see if they're on track?
Just watch the execution on that $1 billion cost cut for 2026. That is the litmus test. If they hit that number, the 2029 dream is real. If they miss, you have to start questioning the whole story.
There you have it. Down on the day, but maybe building for the decade. Thanks for joining us for this deep dive on Talk Tickers.
We'll see you in the next one.